The European Commission wants that big multinational companies make some of their key financial information public. The aim is to increase transparency and to also make sure that big companies pay taxes where they make their profits. In the middle of all the tax avoidance revelations involving the so-called Panama Papers, the Commission has proposed that multinational companies active in the EU should have to publicly report on their European businesses on a country-by-country basis. It will concern more than 6,000 companies which have a global turnover of more than 750 million euro. The information they would have to give to the public is taxes paid, taxes due, profits, turnover, number of employees, nature of their activities, and accumulated earnings. According to EU Commissioner Jonathan Hill, he did not put forward this proposal because of the Panama leak, but the Panama Papers strengthened the Commission's view that the companies should pay taxes where they make their profits. And with this proposal, they will come under public scrutiny.
This information will give a clear idea of whether a large multinational is paying tax where it makes its profits.
But will 7 pieces of information made public on a company website really stop multinationals from dodging taxes? The answer from both businesses and those calling for more transparency is no. James Watson at Business Europe thinks it's better if just tax authorities get the information, something that the Commission proposed earlier. To make it public will only create uncertainty for European businesses, he argues. And it could also make Europe less attractive for foreign investments. But it would not stop companies from cheating.
Well, there'll always be some people who want to cheat the system, whatever the system may be, and perhaps in whatever area we're talking about. But we do think tax authorities themselves are the people who are best placed to enforce international tax legislation.
Tove Ryding at the organization Eurodad is on the other hand calling for more public information, but still she makes the same assessment. The information that will be made public will not stop tax-dodging companies. The reason is that multinationals will only have to report country by country for the European activities. For the rest of the world, they may just give an aggregated figure of the total taxes paid. The exceptions would be tax havens. If a company active in the EU does business in a country that is on the tax haven blacklist, which the Commission will put forward, then the company would have to give more detailed information also for that country. But Tove Ryding argues that this won't work. She has no doubt that there will be countries where big companies can still hide money from being taxed. Countries like Switzerland and the US, countries that the Commission, for political reasons, will not blacklist.
We'll get a lot of new numbers, but they won't show what's going on in tax havens, and they won't show whether rich people and multinational corporations are not paying taxes. So we cannot use the data that comes from the Commission's proposal. It won't be a solution.
With this proposal, the Commission has tried to take on board the views of many different stakeholders like NGOs and stakeholders like the businesses. But in the end of the day, the result may be a half measure in the fight against tax avoidance.